Good afternoon, everybody. Today is April 9th. Michael and I are recording this. We want to welcome you to our spring 2025 market update. We hope you're doing well, and we have a lot to update you on. Michael, how are you doing today?
Doing good, Kevin. How are you doing?
Doing well. I feel like we've got a lot to update our clients on. There's a ton going on. Almost have to laugh about it simply because every day seems, for those that are watching the news, there's a ton going on, and I think we could probably start this in a million different ways. But what do you say we dive in, and where do you think which direction should we go first?
Well, I agree. There's a lot going on. I'm looking at my iPhone. The S&P 500's up 7% today, so was down a lot here and there over the last week. But I can't help but think about a couple things. One, I love this quote from Thomas Jefferson. I was watching Ken Burns had a documentary on Thomas Jefferson that I think I was actually watching over the holidays. Thomas Jefferson said, "The man who reads nothing at all is better educated than the man who reads nothing but newspapers," which is what I did not know from back then is that even back then, over 200 years ago, obviously, the newspapers were usually, a particular newspaper was in favor of a certain political candidate at the time, and another newspaper would be in favor of a different political candidate. So they were kind of propaganda machines back then, and it just reminds me of, if you flip on your news channel of choice these days, if you're getting some financial news, there's going to be a political spin to it. And so this is a market update. This is not a affirmation or a criticism of what's going on in our country. This is going to be more of a common sense kind of how do we control what we can control strategy session. But it is a good reminder that kind of like maybe the recent Morgan Wallen country music artist critic. I'm a little crazy, but the world's insane. And so we'll talk today about how to maintain some sanity and think about what we can control, make smart financial decisions that have allowed us to achieve a lot of success in the last in both recent times and over the last several decades. So I'm excited to get started.
Thanks. I think even just with news, I kind of laugh sometimes. We talk to clients. It's if you can't read one thing, you can't read another. It's like, what can you read, right? What can you trust at times? And I think especially in the financial news, just want to highlight that's why we put a lot of time and effort into our monthly updates that we send out, sometimes more frequently, but just so important to be able to know and be able to trust where information is coming from, and that's why again we'll just kind of report on what's been happening. So speaking of, I do kind of just want to start here and dive in. We show this slide quite frequently, but this is just to really for times like this to say, volatility is very common and normal. This slide does show, as you can see, that the average intra-year decline is about 14%. And so, as Michael said, the market's up 7.5% or so today alone. Today alone, we've almost seen a 9 or 10% swing. This year, though, at one point, this data is as of March 31st. It was a 10% decline, so meaning it wasn't even quite normal, although it was very quick and rushed and felt very abrupt. We would also somewhat call it very normal. And I think it's just good to point out, how the S&P 500 has done so far this year. We think it will continue to be volatile, and today alone speaks to that. Michael, would you add anything else to just, over your 20-plus year career, the volatility that you've seen and kind of how, in some ways, this is really no different, although it does feel different?
Yeah, it certainly does feel different in some regard. Just looking at some recent kind of movements in the market of kind of where we've been at late last year, really maybe late January of this year, using this chart, which we frequently look at, you would have to conclude that a 6,000 point drop in the Dow would be considered very, very normal or common, or however you want to say it, very annual, very frequent, if you could say that. So that doesn't get talked about enough. because we're always in our culture so focused on trying to control things that we simply cannot control. And so it leaves us in this, position of kind of anxiety, like the sky is falling. And the reality is the market just needs to pull back and every once in a while. And so we're not going to ignore all that's actually happening in the world right now on this market update either. But it is important to understand that those pullbacks are very common. The more I think about economics and, what's obviously in the news right now is, are we going to have tariffs or are we not going to have tariffs? Are these going to be actual tariffs? Are they going to be long-term tariffs, short-term? Or is this just a negotiating tool? Is it really going to be worth the tariffs to have the jobs brought back to the U.S.? How quickly can we bring those jobs back to the U.S.? And is that all really going to be worth it if the market's down and inflation is high? So, the administration is obviously trying to do a few things at once. It'll be really interesting to see how much they are able to lower taxes and lower regulation. But their formula, rightly or wrongly, whether you agree with it or disagree with it, is to lower the cost of debt for both houses and cars, actually, is in their plan for the consumer. They want to lower regulation, provide more freedom for the capital markets. They are trying to lower taxes significantly. I think that'll be in the news over the next month or two, much more than it is right now. Increase tariff revenue, bring jobs back, and hopefully not wreck the economy in the process. So it's very kind of ambitious. I think what I would say, to answer your question, Kevin, is this is the first time in my 20 plus year career in the financial services world that it's kind of coming, a potential or an actual market downturn is really coming from something that's actually self-inflicted. The differentiation that I feel significantly is this administration is trying to avert a crisis or avoid a crisis. There are a lot of there's a good portion of our government debt needs to be refinanced this year, and which is one of their motivations to bring interest rates down. I don't know if we'll ever really know if that crisis will be averted, but what feels very different is that if you think about the crises that we've experienced over the last 20, 30, 40 years, most of it is, there's a saying that we have around here, it's not the bus that you see coming that runs you over, it's the bus you don't see coming that really gets you. And so in this current period, we have a administration in power that's at least trying to avoid a bust that they do see coming. The point that the difference to me is that it's obviously very self-imposed, self-inflicted. The administration's efforts of what they're trying to accomplish, and it'll just be interesting to see how it all plays out, because in most crises, there's no really anyone to blame until kind of afterwards. A lot of people that maybe saw it coming or didn't see it coming but didn't do anything about it. So it'll be very interesting to see how this plays out, obviously.
Absolutely. Yeah, I think, again, just a reminder that we're going to, volatility means up and down. We're going to continue to see that the rest of the year. Again, even as of March 31st, the market was down 5. If we would have recorded this yesterday, it would have shown down almost 16. But today's bounced back so much, we sit down about 8. So I want to kind of transition, Michael, to something that we don't quite frequently show. It's this slide right here. It's dealing with PE ratios, which essentially is just showing, okay, based on the profitability of these companies, where are they trading? I think this comes from a point where, the market, we hear commonly from clients, hey, are we getting high? Does it feel overpriced? And so I think just maybe spend a few minutes, Michael. What are your takeaways from this slide? Why do you think this is important to be evaluating now? And just kind of give us your insight and your thoughts.
Yeah, what's kind of amazing on this chart is it's got almost 30 years of data, and even that's not quite long enough to really understand how history continues to repeat itself in the market. I think you're right, Kevin. Before some of this decline that's happened in early April here, by the end of March, the S&P 500 was still trading at a PE multiple of 20, which means that, price divided by earnings. So for every dollar of earnings per share, the stock, if you had $1 of earnings per share, the stock would trade at $20. So all that really is a multiple. And this from this chart, there's a lot of inconclusive data, but there's a couple bits of pretty telling historical data. And I just would say briefly that before we got kind of a bad decade, which in the stock market, where the stock market, when you net everything out, was kind of a roller coaster that went nowhere from 2000 through 08. So that 9-year period, to start that out, the market was priced at about 25 times earnings. And then by the end of the decade, which was March of 09, by the end of that bad, technically 9-year period, the price earnings ratio was at 10 roughly. So $10 or $10 stock price for every dollar of earnings per share. All we really know is that the worst decade we've had in recent history started with a PE multiple of 25 and ended with 10. So what we kind of know from history is that history is suggesting that 25 is too high and that 10 is too low. That's a pretty wide range, which is why we pay a little bit more attention to things like the next slide. But it is important for us to address this idea that prior to even Trump and being inaugurated, there were comments about the market being priced too high. In our view, it's not priced low. It's on the higher end of things. We would not suggest that it was too high, but it is something that I think if you're a client of ours, you will hear us talk about more in the next 5 years than you've heard us talk about in the last 5 years. And that is very telling, especially when you look at the data on the next slide.
Yeah. Yeah. I think, you mentioned at the beginning of the slide, maybe this isn't long enough history and conclusive. So we'll zoom out a little bit more on the next slide. But yeah, I do agree. It's like this, this slide would essentially say, we don't think it's overpriced. Is it warming up? That's how I recently described it with a client, maybe, but no reason currently that we think it's too not touching that current or the 25 multiples that we've seen in the past. So yeah, let's zoom back out. So again, now before it's we'll call it 30 years worth of data. This is going back to 1926. So now this is a lot more data. Why are we looking at this now? Why do you think it's important? And what do you take away from it, Michael?
Yeah, so there's if we were to show this in kind of a dynamic PowerPoint form, we'd kind of put the yellow line on there first, and you'd kind of ignore everything else. And for those just listening, the yellow line it's a 6.5% trend in the S&P 500. That's our large cap stock index, domestic index. 6.5% is essentially the return over and above inflation. So you add 3 to 4% inflation, you can get to about a 10% rate of return or average annual return on the S&P 500. So if you have a 6.5% trend line over and above inflation, then you kind of look at the blue line, and you see how the blue line, which is kind of the actual return of the S&P 500 index, you'll see how it kind of goes like below the yellow line, and then it goes above the yellow line, and then below, above, and below, which makes sense, right? We all kind of understand that. If yellow line's a trend line, blue line's kind of the actual line. Well, what you really want to know, and what we've really not shown it this way before, but this chart from Riverfront Investment Group was really well done by them. That if you really if you kind of focus in on the 1930s and that Great Depression period, you obviously went above the trend line to below as years went by, as time progressed and the market went nowhere, or was a roller coaster that really made no progress, then obviously you're going to get below the trend line. And so we start to think about the saying we have around here is we don't really so much worry about bad years, we worry about bad decades. And so the 1930s was a pretty rough decade. But then from 1940 through really the mid 60s, you had a pretty good 25-year-ish period that had kind of a stage 1 and a stage 2. And we'd really call that not a secular bear market. We call that a secular bull market or a long-term bull market. Well, same thing happened. Really from mid 60s to mid 70s, you had another secular bear market, basically another roller coaster type decade where once you netted everything out, you didn't really make any money. And then the same thing kind of happened from the mid 70s through the 80s, 90s, up until late 90s, really early 2000, like we just looked about on the previous slide, you had another secular bull market. And then from 2000 through 08, like we just talked about, you had a secular bear market. And then the kind of the top right part of this graph is really highlighting again what happened in kind of from 75 to 2000 and from kind of early 40s to mid 60s. You really kind of have stage one. Stage one of a long-term bull market is when the market goes from technically underpriced to appropriately priced. Stage two, and this is important, stage two of a long-term bull market when it is trying to identify when does the market go from fairly priced to overpriced, and then the cycle repeats itself. So it's basically underpriced to average priced to overpriced, and then underpriced again. And so the challenge is the market gives over time and then can take away pretty quickly. But the net of all that being obviously significantly positive. But I think, again, just similar to what we just said on the previous slide, what we're paying attention to is really when is the long-term bull market that started in 2009, where you've had about a significantly positive rate of return on the S&P 500 index since 2009. When might that end? And nobody will be able to time it perfectly. And I would certainly not listen to anyone who says that they can. But there's certainly moves in the portfolio that can be made with a greater wisdom if there's more attention to kind of these longer term market movements and trends.
Thanks, Michael. Is there anything besides PE ratios? Like if I'm a client, I'm thinking, okay, well, when does this, from the graph perspective, the blue box, like in stage two, as you described it, PE ratios, is there anything else that a client should be kind of paying attention to from that perspective, or know that we're looking at to kind of, obviously as their kind of advisor and guidance? Anything else you want to speak to besides PE ratios?
Yeah, there's certainly a lot of things that we are certainly looking at. It would certainly be up to any client's individual appetite. I think when we talk about asset allocation here in a second, I think that's probably the most important thing that I think of, because there's a lot of studies out there that show that 95% of your investment performance is going to be driven by asset allocation, not what individual mutual funds, ETFs, or stocks you buy. So we'll talk about that here in a second.
Yeah, I think that's great. Well, so again, this chart's really showing what's going on with the market. I think next, let's move here on this one. I think this is, again, we're trying to demonstrate here is, okay, well, that's great, but what's actually going on inside companies, meaning how healthy are they? What do profit margins look like? And so let's kind of go back. This, again, we're going back 20, 25 years here on this slide as well. Why don't you talk through why we think this slide is significant and some of the takeaways from it?
Yeah, this is just a simple profit margin historical graph that goes back about 20 years. And you can see profit margins are really near all-time highs. That does not mean that the market can't go down quite a bit, as we've seen. You can see in 2008, profit margins had gotten above 10%. In 2008, they got basically cut in half. The stock market also got cut in half. There's a little bit of an interesting kind of some of the art behind the science, or some of the art that goes with the science, is that it's a bit of an accounting thing. But if publicly traded companies already know that they're not going to beat or meet analyst expectations in terms of profits, they will find some other things that they may need to write off, and so they can start to kind of clean up their balance sheets, so to speak, even more. Some of that I think was happening in 2008 for sure. That's just kind of my opinion, but I think you could probably prove it if you really wanted to. So I think that drastic dip was probably a little bit more significant than it really needed to be. But there was certainly a lot of fear about the very liquidity, the validity and the liquidity of our financial markets at that time. But you can see since 08, really going back to the beginning of the chart, since 02, we've kind of had a steady climb of large cap companies in the U.S. growing essentially their profit margins, which is their earnings divided by gross sales, from the 8% range to the 13, 14% range, which is really, really positive. So It's just important to remember that we're not investing technically in the market. The market is just a kind of a group, emotional groupthink type thing. If we priced our houses every day like the way we price publicly traded stocks, then if nobody came to buy your house that day, that technically would be worth zero, which makes no sense. But that's the way we trade publicly public stocks. So it kind of makes it more chaotic than it makes it feel more chaotic than it really is. But when you really look at what's going on inside of companies, you see steady inclines in profits, which is a good thing. So this number is still going to bounce around a little bit, but it's a good thing to see. I think companies generally are pretty healthy. The economy generally pretty healthy. That sounds weird to say. Sounded a lot more normal or easier to say maybe a month ago, but I think a lot of that's still true. So
yeah, I think that's great insight, and yeah, a lot going on with this. I mean, even in general inside of companies, when you factor in inflation and other things and how they pass that along to consumers, and their earnings look solid. You mentioned this earlier as far as like portfolios go. So again, we kind of went from the market per se to what's going on inside companies to let's look at portfolios and what's happened so far. Again, as of March 31st, this data has changed even quite dramatically in some senses. As mentioned before, the market's up almost 8% today. But this is just a breakdown of what's going on inside of large cap, mid cap, and small cap. And then even within that, the value versus blend versus growth. So we could say a lot about this, but Michael, where do you kind of want to direct this and say today in relation to just how the market's performed and asset allocation?
Yeah, nobody wants to see their portfolio go down, and we certainly understand that. But it is important to just understand, if you're looking at individual holdings, then over the last 5 to 10 years, your top performing holdings are probably in this top right large growth category. There's a lot of reasons for that we don't have to go into today, but companies that are essentially going to reinvest in themselves are going to probably be a little bit more risky because they pay out less cash. So they're asking for you to be a little bit more patient because they're reinvesting in themselves. And the other thing that I would say is that if they are going to reinvest in themselves and ask for you to be a little bit more patient, they're going to give you a little bit higher rate of return. So that's kind of the large cap growth category. But through March 31, large cap growth was down 10 and large cap value was up 2.1. More of the dividend type company that's going to pay out more cash. Large cap value is a little bit broader category than just dividend related companies that pay dividends. But it is important to have several different things going on in the portfolio. There's a the way we like to kind of say it is all really 9 of these categories, which really exclude these are all domestic stock categories. So you could add international stocks, kind of add 1 or 2 more categories. They really are all winners over the long run. We don't really have any losers in any clients' portfolios that we manage. But if they're all winners over the long run, you're still going to have a winner and loser each year. And so certainly don't know what's going to happen for the rest of 2025, but it's really important to stay diversified, to stay humble in a good way. There's a difference between staying humble and settling for less. If some of these asset classes did not have high rates of return over the long run, and we had them in the portfolio, then Kevin and I would argue that's settling for less. But if they're all winners over the long run, then it's okay to still have, one of them has to lose each year. And so in the 2000s, large cap value beat large cap growth by a lot. International beat domestic stocks by a fair amount. So small cap beat large cap by a decent amount in that decade. Since then, it's been, little reverse, but it'll be interesting to see how things play out here on April 9th as we record. Large cap growth is down 11% this year, and large cap value is down only 3% this year. So you're seeing still a pretty significant difference between those two asset classes. So the good news is we've got a really really healthy amount of large cap value stocks in most client portfolios. So.
Yeah, I love that. I think the best analogy I've heard you use, Michael, is, even when constructing a portfolio, obviously, they're all unique based on the client's goals, but depending on the client, right? We use the analogy often. It's kind of like baking a cake individually. The ingredients may not be great, but when you blend them together, right, you get better results. And so we're not using all of these asset classes equally in anybody's portfolio. And we'll talk about maybe even some shifts we've seen between growth and value at some point. But just know, inside of that, yeah, you probably hold everything inside here, but obviously in different quantities depending on some of what's going on in the market. So, as you mentioned, this is really just domestic. We hear a lot about international, especially the last several years with what's going on, mainly with trade wars with China, Ukraine, Russia. International becomes more and more common, I would say, to bring up. And so we kind of want to shift to international, because international has actually been positive. And Michael, why don't you just talk through maybe going back to 05, last 20 years of data, kind of U.S. versus international, and kind of where we see a little bit of appetite.
Yeah, this is certainly something that we've kind of been waiting on a while, but it'll kind of float. International versus domestic stock returns for a U.S. investor. Part of the return is certainly affected by the value of the dollar relative to foreign currencies, depending on where the other international stocks are traded. But yeah, as of right now, the main international stock index that we track is up about 4% this year. So you start to think about over the last several years, things like large cap growth beating large cap value and beating international, outperforming, pretty handsomely. A lot of that's reversed this year so far. So we'll see. But one thing that we certainly pay attention to is essentially a kind of a price to earnings discount of international stocks versus U.S. It just is one way of looking and to see which one is cheaper. And so for the last 20 years, we've never been at a spot where international stocks are more cheap or more discounted relative to U.S. stocks. That doesn't mean international stocks are going to outperform. There's certainly some other things going on out there in the world, kind of global economy. There's some reasons for this, but it is something to pay attention to, and we are implementing this in our asset allocation decisions. So,
yeah, I think it's super insightful. And again, just kind of speaks to what's going on. And obviously, it's very complex, and we'll continue to keep a close eye on this. And we're not, this is not a major strategy shift, but just something to really pay attention to as this year progresses. Mike, I think it'd be maybe good to, I want to get to tariffs. Obviously, I know that's a big conversation, probably the most common word in boardrooms and all across the news right now. But one thing that's kind of we've stopped talking about, that was probably the most common thing to talk about, maybe 6 months ago, was debt. And so why don't we kind of bring that back to the forefront and talk about, okay, where is debt, and kind of your thoughts on this slide right here.
Yeah, just as a quick history lesson, because we're throwing a lot at you guys in this market update, but it's there's a lot going on right now, so it's fun to do, and this is what we're here for. So, but as a quick history lesson, our country's only at least we've really only hit a point where our federal net debt, which is accumulated deficits, kind of total debt as a percentage of GDP, you can see in the late 40s, really most likely because of World War II and how expensive it was, we had borrowed an amount that was greater than our country's GDP or gross domestic product. And you can see we've been kind of approaching that number in the last 10 to 20 years and getting very close to it. At times have probably exceeded it, depending on how they're kind of taking these snapshots. That's certainly not ideal. What I just wonder about as an investor myself, and certainly as an advisor, is this a bit of a kind of a test, a limit test, so to speak, where this is maybe as much as society wants to tolerate or our economy can handle? I think that's some of what I think about and some of where my comments a minute ago were coming in terms of this will either be a crisis averted or we'll never even know, or is it just some of the ideas were really smart, some of the ideas were really dumb, or some of them they were all smart or all dumb, and some of them worked and some of them didn't. But what I really think about, what I do know, is that I don't think Congress. We've put it this way. We've had. I'll give you this example. Kevin, you know this. We've had clients for years say we can't keep printing our way out of this. We can't keep printing money and getting away with this. And we'd kind of nod our heads like, yeah, we know. Like that's not a nobody would run their household that way. You can't just print more money, right? And yet it's kind of like Congress is not really gonna. It's hard for Congress to really do anything about it. It's hard for them to do anything about the problem because their allegiance and loyalty to their own constituents, and all their constituents are asking for something, whether they're asking for a lot or asking for a little bit. So it's just a kind of a fascinating political period, probably frustrating for many people. Some people might be glad. Again, that's not really the point of today's market update, but it's a fascinating political period, I think, in our country right now, that we actually have an administration, either clumsily or intelligently or anything in between, attempting to really deal with this. Department of Government Efficiency, or whatever they're calling that, DOGE. So there's really a lot going on. That's why I was kind of thinking about, economics is kind of like nature. The more you learn, the more you see how complex it really is. What'll be interesting and just fascinating to me is really what that forecast looks like. I think based on what I'm seeing, I don't know if I'd expect the government debt to continue to go up, but I certainly hope it comes down to a much more manageable level. But I think history is, I guess my main point is almost just for entertainment, curiosity value. I think history is playing out before our eyes. It's from an investing standpoint, it can kind of threaten to maybe cause a lot of anxiety or drive us nuts, and I totally get that. But from a political standpoint and what's going on in our country, this administration was elected to do some things, and it'd just be interesting to see how it plays out. So,
yeah. Well, thanks. Yeah, I mean, we could honestly spend a lot more time there, but I'm going to keep us moving here with just inflation, and again, another topic that's really all we talked about for 9 months, because inflation, hit almost 9% at times, depending on what your source was. And so why don't we talk about where it stands now and where maybe you see this going?
Yeah. I think in terms of where I see it going, it'll be really interesting to see how tariffs impact inflation. Tariffs can certainly increase inflation. I think the challenge that our country is really facing is that you can see in the far right section of this graph, inflation has come year over year. Inflation has come down, which is great. It needs to be more in the 2 to 4% range, not in the 6 to 7, 8, 9% range. The challenge that our country is still having, and I think this played into what happened politically too in the fall, is inflation is still cumulative. So if year over year inflation is coming down, back in 2022, 23, the fact that we had high inflation, that has a cumulative effect, because just because inflation is coming down, that doesn't mean we have deflation, as we all know. That doesn't mean prices are coming down. It just means prices are going up at a slower rate than what they were going up in 22 and 23. So obviously that cumulative hangover ongoing effect of inflation is just something that's going to cause people to vote one way or another. That's not a political statement. It's just that's how it played out this past fall. But that can really go both ways. So
yeah,
well, I think it'll be good to touch on that here in a couple slides when we have kind of how to really protect yourself from that.
Yeah, absolutely. I just say with inflation, it's kind of what's always the big buzzword, right? And right now it is tariffs, and so we're going to move to tariffs. But just know, I think this is a really important thing to keep our eye on, because it is inflation, because this is a really key indicator with a lot of other things, and interest rates, and what businesses are doing, and how they're borrowing, and people spending. So we won't lose sight of that, and we'll continue to remind you all that we think it's important, and we'll definitely keep a close eye on it. So yeah, to move to tariffs, I kind of even have to laugh at this because it just moves so fast, Michael. Just looking at it right now, the S&P It's back up to it's up 9 today, really simply based on tariff comments. But this estimate, whether the March 31st, I think between March 31st and now, probably 5 different things have happened. So I think that's important to note that this data is the March 31st. But our tariffs a negotiating tool? Are they here to stay? Like, there's so much going on that we could talk about it. But what do you think is most important for our clients or anyone listening to this today to hear in relation to tariffs?
Yeah, this chart goes back about 100 years, and it's I'm not sure how helpful it is to really understand that, or to be told that tariffs have certainly been higher in this country before. I'm not sure that really matters. I do find it kind of fascinating that there is kind of this it's okay to have for other countries to have higher tariffs, but the U.S. if we raise our tariffs, we're kind of the bad guys. But I'd also totally get it. We don't live in a vacuum, and it's not about good guys versus bad guys. It's about we're always going, because we're the strongest economy in the world. The policies that we set can also help or hurt us more. But it is kind of fascinating, just if you ignore the which is impossible, kind of the financial and investment effect of things. We have certainly had higher tariffs previously. You will find good economists and political leaders, historians on both sides of the political spectrum, or with different economic philosophies, that will all have different opinions on how the tariffs in the 1930s affected positively or negatively our country. But for sure, the consensus among most people in the investing side of things would agree that free market capitalism is a big deal, and the more that goods and services can flow freely, the better off the consumer ends up being, and because of that, the shareholder benefits. And so you as an investor, for our clients as investors and shareholders, that's obviously this huge spike on the far right is obviously why we're seeing a lot of volatility in the markets.
Yeah, and I'll just quickly keep us moving. We would always say, the market is leading the economy, right? So in a way, a lot of the reason for all the volatility, as a lot of people know, is the market had priced in a certain amount of tariffs, and that exceeded it for a while. And then even today, again, because of pullbacks, is now the market's just trying to figure out, okay, what our tariffs are, what are they pricing in, and how does that differ from what is being priced in? And because that is such a moving target, that is why we're seeing more volatility than usual. So we'll continue to watch it, and we're going to talk here soon about our philosophy, even with portfolios here in just a second. But yeah, what does it mean, Michael? Let's transition to a few different slides showing different types of portfolios over 1, 5, 10-year rolling periods. This goes back all the way to 1950, so we're talking about 74, 75 years worth of data. Why are we including this, and what do you want people to take away from it?
Yeah, I think about, you start to see some commercials pop up. If you're always going to have certain investments that will overpromise and underdeliver in various ways. I laugh at some of these commercials I see about, the things they say on precious metals commercials advertising precious metals as investments. I don't even understand. We're not even allowed to say things like that as registered investment or investment advisors who are licensed. So I'm not sure how they get away with it, but it is very confusing for the average investor. And so you're certainly always trying to manage risk. Warren Buffett was right when he said proper investing really starts with risk management. And so I think on a slide like this, we're just looking at really two sections. We know that, in a 1 year period, the stock part of our portfolio can probably go down 40 to 50%. We also know that it can go up, 50%. But we're more worried about the downside as human beings, and I think that's totally fine. I think that's just kind of the way that we are. The over a 1 year period, this chart kind of shows, this data goes back almost, roughly 75 years. A 60-40 portfolio, or a 60-40, 60%, 40% stock to bond mix portfolio can still go down about 20%, which makes sense. But just over 5-year rolling periods, you make money 98% of the time if you have all stocks, 98% of the time if you have all bonds, and you actually make money 100% of the time. You actually make 1% or more 100% of the time if you have a 60-40 portfolio over a rolling 5-year period. So what am I saying? What I'm saying, Kevin, is that you don't have a guarantee that you're going to make money over a 5-year period, whether you have an all stock portfolio or a 60-40 portfolio. But historically, there's not much in life where you go in with 98 to 100% odds. And past performance is no guarantee of future results. We know that. That's what we have to say if we're going to run a commercial or do a market update. And so that is still true because there's just no guarantees in life. Very, very little. But I just cannot think, Kevin, about really many areas of life where historically, we're quote unquote almost batting 1,000, as they say in the baseball world. It really amazes me. And a 5-year period is a very short time frame if you really think about it.
Yeah, I think it's like, where are you going to get those kind of odds? And I think, again, it's another reason that when we do market updates, we're not focused on this quarter. We're not focused on this year. Generally speaking, we're focused on a wider time frame because of that. It's like it's a good reminder, because if you just look at short term, it's going to think like, oh my gosh, should we be selling? And I think we'd very clearly say it's never a good time to sell because we don't know what's going to happen short term. I've gotten several phone calls, obviously, and I know you have too, with what's going on in the market. And, it's that reminder of that quote of Warren Buffett said, the stock market's the only place that when things are on discount, people flee, right? And it's a good reminder to our investors. Okay, look what happens on these 5-year rollings, on these 10-year rollings, 20-year rolling, like where we think we are. Obviously, we're going to take advantage of certain sectors when we have all this volatility, but we don't think it's the time where you get out and stay out ever, from our perspective. So I think this is a really, really good picture of that and why we use the timeframes that we do.
Yeah, and I think one just other quick takeaway is if you said, hey, here's an investment where over the next 5 years, a 60-40 portfolio, your worst case scenario is you're going to make 5%, and your best case scenario is you're going to make 100%, but your average is you're going to average 50%. So worst case scenario 5, best case scenario 100, but you're going to average 50% over a 5-year period, which in simple math would be a 10% rate of return, or close to it. There's very few human beings that would not take that, and yet there's no guarantee. We have to say that over and over and over again, but we got 75 years of data here, and that's a lot of time that's gone by for the market to kind of repeat itself over and over again. So,
yeah. Well, I'll keep us moving here. I just got 2 or 3 things I want to ask you, Michael, and talk through. But one is kind of, okay, this is allocation, but let's talk about like risk reward. We've evaluated this a little bit. We're just talking about, hey, we want to beat inflation. It's something we're always talking about over the long run with portfolios when it comes to purchasing power and buying power, and this kind of just breaks out even the slides we talked about earlier with allocation on how some things are performing. But why are we talking about this? And again, I'd ask you just the same question I asked before. If I'm a client, it's like, okay, why are you showing me this? And what do you want me to learn? And what do you want me to take away from this?
Yeah, I think it's just important to remember that money is purchasing power. That's all it really is. Just buys you options, literally. Options at the grocery store, options for travel, options for giving, sharing, whatever it is. So if you really think about it, and this is kind of how World War II was financed in that other slide, is the government raised taxes a little bit, but they raised inflation quite a bit. And so if you really think about your different liquid asset classes, the 100 will usually show a version of this that's kind of goes back 100 years. This really just goes back 30 years, and it's almost even more telling that if you had $10,000 over the last 30 years in small cap or large cap stocks, it grew to over 200,000. In bonds and essentially cash or cash equivalents, you had either 60,000 in bonds, 20,000 in T-bills, roughly, and so you just really did not protect yourself from inflation. You might have had protection in terms of less volatility, but as investors, we're always trying to balance the two risks. There's really only two risks that can get you as an investor in your portfolio. Either inflation's going to come tackle you from behind, or the market, your portfolio being too risky or too lopsided. The example would be too much in large cap growth because it's done well recently, but then you're going to go through a decade where you make nothing for 10 years. The reality of this slide in the last 30 years is that you still have to really protect yourself from inflation. That's what really needed to happen if you were an investor post World War II, as inflation was really going to climb higher. Inflation was obviously high in the late 70s. You needed stocks to outperform inflation then. So these are things that are still true today. So, yeah,
I think that's super important. I would just add, like, this is why we think we have to stay in. Again, we're not just staying in, staying stagnant. There are shifts in the portfolio, but we've got to stay in to beat inflation over the long run and from an investment standpoint. And I would just say, even the market is down this year. Obviously, today again it's up. Looking at my thing here, it's up 8.8 again today. It's like, okay, it's just it's another thing to say, like, I think now is kind of it's been a buying opportunity when it's down, and that's more the way we look at it versus the opposite. I know some people feel like they're already all in, so we'll talk about that here in just a second. But I think what's most important is just knowing, okay, what is the history? What are our risks short term, and then obviously what can our reward be long term based on asset allocation.
And so, it's a great irony that most human beings are concerned the stock market and its volatility is going to, like, take their money somehow. The only way you can actually have your money taken from you is if you don't earn enough over and above inflation. The person who put $10,000 in bonds or T-bills over this 30-year period, they can never get, if you didn't outpace inflation, you never get the money back. It's a permanent loss, which is just a kind of great irony, is that it's really the conservative assets that don't earn enough. That's actually how you can actually create permanent losses for yourself. As long as you stay diversified, historically, of course, we've just never had a situation where a diversified portfolio has caused anything beyond temporary declines. So,
yeah, well, I think that's great, Mike. I know we're running a little long, but say one thing just about, like, purchasing power versus capital. Someone who's trying to preserve, how you think about that.
Yeah. It goes back to kind of, don't confuse complexity with sophistication. It sounds really great to say, like, I'm in capital preservation mode. I'm retired, and I think most of our clients are retired. So for those that are watching, listening, don't freak out. It really does always start with risk management, like I said a second ago. But in capital preservation can be a portion of the portfolio, but really half or really the majority, really for most investors, really kind of needs to stay in growth mode. It's just another way of saying it would be, you don't want to be, you just kind of need to stay maybe in the middle lane, going down the interstate. The right lane just is sometimes too slow and doesn't grow enough. That doesn't mean you have to jump over to the left lane either, and be too risky. So that's probably the way I think about it.
Yeah, that's great. Yeah, I think it's a mind shift, right? That's a lot of it. Well, we're gonna end on this. Before I do, Michael, I just kind of want to talk about, again, the market's down. Something that we say all the time is stay the course, right? And I think that's a really easy thing for us to say, right? I think even I hear all the time, well, for me, I'm 36, I've got time. Someone who's older maybe doesn't feel that way, but let's talk about stay the course a little bit. What does it look like for somebody who's watched the market every day? Like, what our clients or anybody who's listening, if they're watching the market every day and they're nervous, What would you say to someone like that in this time?
Yeah, if you're watching the market every day, I'd say me too. And I've got various kind of major index or asset classes on my phone. I can tell, how did large growth do versus small gap, or versus large value versus international versus the bond market, and those are things I'll look at every day. And but I'll look at it with a kind of a curiosity and not with an anxiety. And again, I'm still working, and the majority of our clients are retired, but I still think they have the ability to, and I know they have the ability because they show their kind of perseverance and strength every day, in the way they do this, and let us be a part of their lives. But it's looking at it with some curiosity. I love this quote from Sir John Templeton, who was actually from, I believe he was born in Cowan, Tennessee, near Winchester. Famous investor, and did a lot of good in the world as well. But he says an investor who has all the answers doesn't even understand all the questions. So I think you have to be very, very curious. Remember that no one person has all the answers. We don't have all the answers. And yet, if we really rely on history to be our guide, just know that anything that's happening out there has happened before. There's nothing new under the sun. King Solomon, who said that, and I believe the book of Ecclesiastes, was right. And that's just really, really true. So the person that's looking at it every day, learn to look at it with a little bit of entertainment, curiosity. You're not trying to be flippant about it. You're not trying to convince yourself that it doesn't matter. It does matter, but the daily movements probably don't. And you're still investing in really, really solid companies who are run by really, really smart people, really the brightest people in the world. The brightest business minds in the world are making the most money, running the most successful companies for a reason. That's how they got there. That's part of what makes our capitalist, free market economy great. And so just remember that. And it's difficult to only focus on kind of the things you can control, but that's why we're here to help, just with your asset allocation and your specific security selection, your portfolio, and the things you're delegating to our management. We're going to keep doing that. So
that's great. And I think we just conclude with this. I just want to, for those, to our clients, thank you for trusting us and for letting us serve you. I hope you know our team comes to work every day with you in mind, to work really hard to make the wisest decisions. And it's fun. Michael and I often get to, we think about you all daily, and it's hey, what would it be like to be in their shoes right now? And we're thinking through that. So hopefully you find this helpful, and look forward to hearing some of your feedback, and we'll be in touch soon. So thanks for listening, and we'll be in touch here throughout the year.